Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko and my partner, Hari. Welcome to our podcast. This is podcast episode 41 and 42. Next episode, 41, this podcast.
Yeah, this is where our podcast has a midlife crisis. So
We're going to go buy a sports car?
Yeah.
And a hot wife.
Well, with all of our profits.
Value money.
Yeah.
There you go. We're going to talk about NVR today. This is, you might not think that, this is on the surface it looks like a boring company, but if you look under the cover, it's actually a very interesting company for us as value investors because we like money.
Yeah, and the thing that's interesting about this, and why I'm super excited about talking about it. This is actually one of the first companies I ever reviewed about 20 years ago.
Yeah.
And I was too stupid to buy it. And
shame on you.
30 times my money later, I still haven't bought it. So
shameful.
Yeah. So the opportunity cost here is insane.
It's grand.
What I missed on this. So
yeah. So let's do a deep dive on this company in this episode, talking about the business. Like we always do, we break down every company using our checklist, Value Investor Checklist, which is in front of us right here. If you don't have it with you, please do reach out to us. I know several of you have, and props to you guys. But if you haven't, reach out to us. We'll be happy to send this out to you as well. Just email us at info@valueinvestor.org. So today, like we talked about, NVR, that's what we're going to talk about. But before we do that, just a quick disclaimer. Again, this is, what we talk about in the podcast, this is really educational entertainment purposes. We're not here to advise on your, give advice on your financial situation because we don't really know, and we're not really poised to do that. Right, in this podcast, we use this platform to educate people on value investing methodologies, and also it's an entertainment podcast. So bear that in mind as you listen to our episodes. So let's dive right into our checklist, shall we?
Yeah.
So the first question is, what does the company do, and could you describe what we do, what they do, in pretty brief sentences? Yeah.
So they're actually pretty straightforward. They build homes, single family townhomes and condos in the eastern part of the United States. Yep. And in the places that they tend to try to be the dominant home builder in that environment. So when they're building in an area, they're not trying to be, one of the also-rans. They're trying to make a big splash and, be the big dog in that area.
Yeah.
And so about 23%, 24% as of the 2017 annual report. So they've reported 2018 results, but they haven't issued the annual report yet. So that's why we're using the 2017 annual report. But we will talk about the 2018 financials. So 23% is in Washington, D.C., and 9% is in Baltimore. Yeah. So a fairly large geographic concentration in that area because they're based in Virginia. So but they actually go all the way down to the southeast, to Florida, and all the way west to Ohio. So, they're not and they have two lines of homes. One is called Ryan Homes, which is the lower end. So they say that's the first home a person would buy would be a Ryan home, and then when they are ready to move up, they will buy into their NV Homes or Heartland Homes line, which is more of a move-up or luxury buyer type home. So starter homes versus... So they cover both sides of the spectrum. Yeah.
I want to cover this. I want to touch on what they do specifically more in detail before we go into like geographics and different brands. So they are... So I'm just probing you with these questions.
Yeah.
Do they buy the land, or so how does that work?
Yeah. So it's an interesting kind of thing. So if you've probably seen, there are a lot of companies that do this. Lennar, Kaufman and Broad, KB Homes, I guess what they're called now. And there are several other home builders. So they are a general contractor. So what that means is that they are responsible for sourcing land, building the house, and then selling it to a customer. And they can do this in a lot of different ways. The way NVR approaches it is they don't actually buy up the land. They will buy, so instead of buying like a large swath, they'll buy up rights to build on that property. So they don't actually do the land development, which means they don't develop the neighborhood. They don't develop that. So they're buying it at market price from somebody who has already built up that the land development. So they've gotten permits. This is residential area. They know exactly what they're buying. So they may be paying a higher price than somebody who does land development. But what they're getting is the opportunity to leave if there's something changes in the area. Yeah. So there's a natural disaster, and then that area is no longer fit. They can walk away from that and only pay 10% of the purchase price.
Yeah. There's something that was also interesting. All this contracting is also done on pre-sold basis.
Yeah. So they're not really trying to buy up. When their idea is when they're building the house, they already have a buyer, and so that allows them to kind of preserve their capital. Only about 15% of their things are purchased or canceled later, and that can be for a lot of different reasons. And there's a penalty if they're canceling, but then they would have to find somebody else to buy the house. So the idea there is that they're not going to build up a huge inventory that they can't sell.
Yeah.
And they're not fronting the cost of a lot of this stuff. And then the other leg of this is that they actually will originate a lot of the mortgage loans for the houses that they do.
Yeah, that's another side of the business that this kind of, if you look on the surface, they're just home builders, but if you look deeper into the business, they also have mortgage, banking, and title services as kind of another leg of the business.
Yeah, and so when they do that, what they're really doing is when they buy up the house, or when they originate the loan, they're not the servicer of the loan. So after, after they close the loan, 30 days out, they're going to sell the loan to another provider, a bank or a secondary market. So
yeah, I just want to touch on the geographic diversification, like you talked about, mostly in the mid-Atlantic. Let me just give you guys some numbers here. In 2017, Mid-Atlantic, so that's Virginia, D.C. area, $3.5 billion in sales. Northeast, so I imagine this is kind of like northeast of New York, Boston, that part of the country, about $500 million. So quite significantly less than Mid-Atlantic. Mid-East, $1.2 billion, and then Southeast, $8 million. $800 million rather.
Yeah, and so the Southeast is actually their largest, or is their fastest growing area. Mm-hmm. And so that's, South Carolina, Florida, that area. So they're going to have, there's a lot more interesting things going on in that area in terms of big population growth. So they're building and even though it's a small part of their business, I think that's going to be a bigger percentage going forward.
Yeah. Also, I just want to give you guys the stats because I think this is interesting, kind of contextualize what we're talking about here. The prices at which they settle homes range approximately from $130,000 all the way to $2 million. So on average, it's around $300, about $400,000. And like Hari talked about, there's a range here, right? Ryan's home, starting from kind of budget, lower end, to all the way to kind of luxury offers with brands like NV Homes and Heartland Homes.
Yeah, and those the average sale price, translates to a house of about 1,000 square feet to 9,500 square feet. And I think if you've never built a home, I just built a home.
Yeah, you could speak from your experience.
Using my value investing profits. So I'm fancy like that. The interesting thing about a house when you have it is the general contractor is really kind of responsible for permitting, for making sure all of the subcontractors are lined up and the timing is right so that they can show up on time and do that. So NVR doesn't actually build the house. They subcontract other people to come in and build, do the actual labor, and they do it at a fixed price. So if it's a 9,000 square foot house, that's how much concrete needs to be poured. There's a fixed price associated with that. So when we talk about when we get to talking about competitive advantages and things like that, there isn't a whole lot to be had here.
Yeah.
As far as, they don't have better subcontractors than, say, KB Homes or Lennar. They may actually be using some of the same subcontractors.
Yeah, that's an interesting thing that I want to kind of make sure we pivot to. So when we talk about, the next bullet point in the checklist is, okay, now that we've talked about what the business does, let's talk about the company's competitive advantage. And so we have a list of them. Brand, is it a brand? Is it network effect? Switching costs, low cost, intangible assets? Does the company have any of these or, multiple of these? So that's the question that we have to answer, which is the second question in the checklist. And that's what Har's alluding to here. So kind of running off of that, so you're saying there's no really a definable competitive advantage for these guys.
So they do have a competitive advantage, and it's a little bit hard to quantify how you would put that into, our checklist.
Mm-hmm.
And they may have a brand, in that. Let's step back for a second and tell you how they sell a house, right? So they're going to go to an area. They're going to put up a model home. This is very standard in, when you go to the suburbs of most cities, the way that they build houses is they'll have a neighborhood with a lot of their own homes, and they'll have a model house that's kind of fully furnished to kind of give you an idea of what your house would look like. You walk into that, the garage of this place, and they'll show you different, carpeting, different, styles, different things. And there's a salesperson who's going to try and sell you a house in that neighborhood, maybe take you around, look at some of the homes that are in construction.
Yep.
And then they'll get a commission based on how, what they sell, right?
Yep.
That's kind of the idea of how this process works. So the way that they do this is they're really, it falls into a low-cost provider because they're not floating their business up front, right? They are buying the land, and they are trying to reduce their inventory by not selling houses unless there's already a buyer, right? So they're not building a house and floating it on their own money, right? So that's what they quantify as their backlog, right?
Yep.
And that backlog is, growing every year as they're expanding into, more markets and building more houses. So there is a moat there because when you look at their return on capital, it is extremely high. They're 30% return on equity, and largely because they have, I think, they have a business model that is very cost efficient. Right, they're not sitting on a bunch of inventory and not risking a lot of their capital when they're building houses.
Yeah,
and so that again is hard to quantify. I wouldn't say it's a super wide moat because they are not protected against recessions. When a recession happens, people stop buying new houses, and it really will affect their business.
Yeah.
But that being said, they're also not risking a lot of capital.
Yeah, so kind of going back to competitive advantage discussion here, I think, so like you talked about, price is a big one for them.
Yeah.
Let's say I'm on the market for a house. I am visiting all these model houses. For me, like who does the construction, who manages the property building doesn't really affect me that much.
No.
So brand, not so much. Moat, brand, not really. Network, there's no network effect. Switching costs, low cost, intangible assets. Like you talked about, I think housing, from my vantage point, it's just when we're talking about just regular houses, it's just commodity business.
Sure.
So for these guys, like you said, it's really about the low cost provider.
Yeah.
So low cost provider wins, and like you said, because they have this operational efficiency in capital management, they're able to be that. They're able to be the lowest cost provider,
right,
in this segment. So
now, and that being said, that's not a business model that other people can't copy.
Yeah.
But I think one thing that they've done is that they're a fairly big player in these areas that they are, in the Mid-Atlantic region where they're a very dominant builder. That gives them the ability to say, look, I don't have too many options when I'm buying. Mm-hmm. So if I'm going to be buying, a house, it's going to end up being them just by default, right?
Yep.
They're, if I'm the dominant player in that market, then that means that they've edged out other people, and you don't have much of a choice if you're in the Baltimore or Washington D.C. area.
Yeah. Okay, competitive advantage. And I think we touched on this. The third question is, how durable is the competitive advantage? You kind of alluded to that earlier. So let's move on to the next question. What is the company's long-term perspectives, prospect rather, and runway for growth?
Well, so I think, this is actually pretty straightforward. They're in the eastern half of the United States. They don't operate any international business. They have the rest of the United States that they can go to, right? So, I mean, expansion, 10, 15 years ago, they weren't in the Southeast. They didn't have much of a presence there. So this is something that, over time, they just keep growing into other markets. And so they can buy other companies in other regions, or they can continue to build. So, I mean, I didn't go back, that far, but I didn't see any purchases in their history. So largely what they're doing is just slowly expanding, and then when they get into a dominant position in the market, they just continue to grow in that area. So, I mean, their long-term prospects, I think, are very bright. Every year they're building more homes. Recessions are always a bump for a company like this, but they just continue to expand into new areas.
Yeah, I imagine there will be quite a bit of resistance in the existing markets. The players who already play in that market, for example, if they want to come to Texas, I'm sure there is a player out here that is pretty dominant in Texas market. Sure. So when they want to come here, it's going to be pretty brutal competition, I imagine.
Yeah, and competition is always a problem, right? You have all the way down, like the builder that we used is not a national chain, kind of like these guys are, right? And we met with these people. They were fully custom home builder, and that's what we felt comfortable with, right? This is a kind of a different space, right? You certainly have, even within their own market, there is no way that they can have a monopoly, right? They can't be the only home builder, right? There's very low barrier to entry. One person can be a general contractor, and they can offer their services, and that's actually a fairly common business model. But where they have the ability to do interesting stuff is they actually do joint venture deals on land development and things like that, which allows them to buy up larger parcels of land. And so I think there's also some level of they can buy up more land and sell more homes up front before somebody else comes in. So were they to enter a new market, it's going to be competitive for them to get into a dominant position. But they also they generate so much cash from building these houses that they have the ability to do that.
Yeah, I think, kind of going off of what you said, I think I'm just trying to think in my head, right? Let's say I'm a small competitor to these guys, and they have a lot of cash sitting on their hand. What gives them the advantage in terms of competing in the market? Is it their size? Is it their operational efficiency? Is it their history? I think you touched on just the sheer capital that they have that they can deploy that I can't. So they might be able to buy a whole swath of real estate and do that at a lower cost because they're buying a big chunk. Instead, for me, let's say I'm a small contractor, I only have a certain amount of capital to work with, and I can't scale to that level. So there is some scalability at play here.
Well, I think the other thing that you have to remember is when you're building a house or you're having somebody going to get a house built, working with a contractor can be a nightmare, right? Like we had an excellent contractor, and it was very pleasant to work with. But you can easily get stiffed by these people.
Yeah,
like
sure.
They just suddenly quit in the middle of the thing, and then now you're left with a house that you can't, that you got to go find somebody to finish. These are all of the kind of the problems that you have with when you're building this stuff. So there is some level of, they're a big brand, they're not going to just jump ship, right? So there is something to be said for that. There's also something to be said for comfort in, hey, I bought a house. I really liked it. That they built me a Ryan home, and I'm upgrading to the second level. Mm-hmm. So there's other things that are at play here, and I think also when you look at how people look at homes, because I agree with you that there isn't a whole lot of selling benefits that they have. There isn't, but the scale that they have allows them to do a lot more.
Yeah.
And I think that's where their operational efficiency comes in. I would also say when we start talking about their return on capital, it's insanely high.
Yeah,
right?
yeah.
So there is something going on here that, that we need to figure out what it is,
Yeah.
right? Because this is a very, very well-run business,
Yeah.
right? I mean, from a financial standpoint, you look at this, and you should be very interested in taking a very much closer look when you see these kind of numbers.
So I think that's a good segue into the next question. Does the company require a lot of capital reinvestment to maintain its business? Can it grow without any further reinvestment?
So that first half of that question, the answer is no, right? I mean, they're not actually it doesn't take a lot for them to do this. Yes, they have capital up front, but they're really putting down a 10% on the land, to secure the land rights. Then they're putting down they're actually selling the home before it's completely built, right? And this is, to protect them from having to put up, build a full house, then have a $350,000 house that they're just sitting on their books,
inventory,
for a long time. And so that will happen. Like in a recession, that inventory will build up, and they'll have to clear that backlog of inventory before they start building homes. So there's, you didn't see them really fully recover until 2012. And then in 2012, things just till 2017, things were just going up like crazy because people are buying homes all over the place. Interest rates were super low, and so they're able to make a lot of money, and their profitability just, went up.
Mm-hmm.
So, but they do need to reinvest in their business. But if you look, their capital expenditures is like, $20 million a year for a $9 billion company, because it's basically a people operation.
Yeah.
Right. They do have to invest in, but their employees are basically managing the building of the house.
Yeah.
Right. And
what is it going into, like the CapEx? Do you know?
Well,
like
so their depreciation is actually for their headquarters, probably
Just the building?
the building, and and equipment that they need, like trucks and stuff like that, to get people around, and then they're going to replace that with, vehicles so that people can drive around to visit the sites and things like that. So there isn't a whole lot of magic in the way what you're seeing in this. There's not a whole lot of hidden balance sheet items or anything like that.
Mm-hmm.
This is, if this is the first company you analyze, this is a perfect company to analyze because it is a very straightforward, type of business.
Mm-hmm. Yeah, it's interesting. I'm looking at their cash flow statement, but interesting stuff. We'll go into more in detail the financials in the second episode 42. But let's stay on track here for the checklist. So we talked about the capital reinvestment. Let's move on to the next question. Does the business have favorable relationships with the following: customers, suppliers, employees, regulators / community?
So I would say customers, I haven't heard any complaints. I looked up on various review sites. You're always going to have people who complain about stuff, so it's kind of hard to tell.
Mm-hmm.
And I don't have any personal experience.
Mm-hmm.
But I would also look at their 30-year history of financials and say that clearly they're not having a problem with that. So as far as suppliers go, that suppliers would really be their subcontractors.
Yeah.
And no one subcontractor. These subcontractors are going to be a 5-10 person operation, and they're going to have hundreds of these that they deal with. So, and I imagine the general contractor in charge of an area is going to be managing these people. It's not going to be at the corporate level.
Yeah, headquarter level.
So I think this is a non-issue that they can easily switch suppliers whenever they need to, without much trouble. There is going to be some question, though, I think, when we talk about regulatory.
Sure.
And that's where home building is going to be a problem. So, we built our house after Hurricane Harvey, or it was in the middle of Hurricane Harvey. and there was a lot of flooding in the city of Houston the year before. So our builder actually built in 3 different cities surrounding Houston with all different, requirements. And so Houston had the highest level of permitting. So we had a lot of extra expenses, and they actually allocated about 20%, 10% of our entire purchase price just for city of Houston stuff that we had to do.
Damn.
So, that's a fairly significant amount of
overhead. That's quite a bit of overhead right there.
Right. And
10%.
so when you talk about, and now we didn't actually, they put that into the budget, but we ended up spending about 5% of that.
Got it. Yeah.
Of the total amount
Got
on
it.
City of Houston stuff. So, the City of Houston made us rebuild our stairs because they were an 16th of an inch lower on one side than the other.
Oh my gosh.
So, which is fine. I mean, it's nice, but
Sure.
we had the most anal retentive inspector, right? And so if you build out in the country like my in-laws did, there was no permitting, right? You could basically build whatever you wanted to.
Yeah.
So that obviously saves you money, but it may make the house less safe, or maybe it may not.
Sure. Yeah.
So.
Yeah. So it's interesting relationship with regulators. Also I think with loan origination also, there you have to deal with the regulators here on that front also.
Right.
For this business.
Yeah.
Because remember they do home building. Obviously we talked about that, but they also do the loans and the title services.
And the mortgage stuff is actually fairly profitable, right? Like a lot of that just goes straight to their bottom line, when you look at their cash, right? They originate the loan, they have a closing cost associated with that, and that's basically all profit. So
Yeah. Yeah. Anything else you want to add regarding that? Regarding this question?
No,
Or any questions above?
No, I think this is a fairly straightforward business to understand. There's not a whole lot of magic. Their annual report is like 60 pages long. And I think the business introduction is like a page and a half.
Yeah.
There's not a whole lot there.
It is pretty simple, yeah.
So, we're if you're seeing like what's the secret here, there's not really a whole lot. So
Yeah, we'll talk about why this company is so interesting in the second episode.
Yeah.
Because I think that's really, when we talk about numbers, that's when this company really shines.
yeah.
So we'll talk about that in the next episode. Thank you guys for joining us in this episode 41. We'll see you on episode 42. Thank you guys.
Thanks.